You're already looking ahead to tomorrow's big jobs report, but yesterday we had the ADP jobs report, higher than expected. Does that kind of give you a hedge of what we're expecting, what we're going to get tomorrow, and how does that make the markets move?
Well, I think we have to think that ADP number sort of curbed the enthusiasm yesterday a little bit within the market. You know, it didn't go down sharply or anything like that. But we'll have to look and see what happens tomorrow. We're expecting that the jobs number will be lower than it was in the prior month, and that would indicate that the effect of the Fed's policy is beginning to work through the system. You know, it's not it's the important thing to take a look at. I think we're looking for an amelioration in terms of the economy running hot, looking for it to not necessarily cool, but to move a little bit off of the hot button, so to speak.
All right, I'm looking up amelioration. I got to be honest, I don't know what that means, John. Spell this one out for us. Better than expected job report, good for the market or bad for the market?
Better than expected job number would be bad for the market, okay? But it depends how, if the number is, how hot the number is, will really depend upon how the market reacts. It can, as it showed with the ADP number, it wasn't a big deal. You know, it wasn't a deal breaker. If anything, it just was. It was a very modest losses yesterday that I saw on the screen.
All right, so you're saying you're all about the GARP trade. I think everybody's looking for growth at a reasonable price. But after we get past the idea of looking for growth, what's the next metric? Yesterday I was on Halftime Report. Kevin O'Leary was all about the free cash flow. Some people are all about margins, other people about dividends. For you in this market with so much volatility, what's the key factor that you're looking at when you're picking a stock?
I'd say it's a mix of all those things. You're looking for cash flow, profitability. You're looking for strong management, ideally a dividend to come along with that. And products that really keep the loyalty of their customers, as well as a dividend policy that keeps investors in the company loyal to the company. We look at it as growthier value, GARPier growth. So we don't want to stretch and go out too far in terms of when will a company be profitable or something like that. We want companies that have shown that they can navigate tough times. And we've had plenty of tough times over the last 13 years, 14 years to find good examples of that. And many of these really good stocks are deeply sold off in the course of this year's performance.
John, we've had some tough times over the last 13 weeks. It's been a pretty difficult second half of the year. So I also want to talk about something that you're saying. Look for stocks where the baby is thrown out with the bathwater. That sounds like maybe a kind of different take on buying the dip. When you say look for stocks, you said no?
No, I said very right, Howard. Absolutely. When you're looking for babies that get thrown out with the bathwater, you're looking for stocks that are really good companies, like the ones I'm defining that you want to own, that just happen to get thrown out on these down days when the market broadly just takes them all down. And that's one of the things that's been very much a hallmark of the sell-offs that we've seen of late, has been broad selling that crosses whether it's defensives, whether it's cyclicals, whether it's large cap, smalls, or mids. It looks pretty brutal. Reminds us of '08, although we don't think there's anything like this. Is not '08. This is very much 2022, and it's a process of moving from free money to an environment wherein bond buyers get paid for lending their money essentially to a bond issuer, and bond issuers have to pay for the privilege of borrowing money. During the pandemic, we moved from accommodative policies really to free money, which was boosted by overstimulation, we think, by politicians, and that turned out to be very bad for inflation.